Number 1. What is inflation? To comprehend the impact of inflation on investments, we first need to grasp what inflation is. Inflation is the gradual increase in the general price level of goods and services in an economy over time. In simpler terms, it's the phenomenon where your money buys less tomorrow than it does today. It's often expressed as an annual percentage, indicating the rate at which prices are rising. Number 2. Inflation's erosion of purchasing power. The most direct impact of inflation is its erosion of your purchasing power. As the cost of living rises, the same amount of money buys you fewer goods and services. Think of that dollar in your wallet. Its value diminishes over time due to inflation. This erosion can significantly affect your ability to achieve your financial goals, like buying a house, saving for retirement, or funding your children's education. Number 3. The impact on cash and fixed income investments. Inflation hits cash and fixed income investments like bonds particularly hard. When you earn a fixed interest rate, such as with a savings account or bonds, and inflation outpaces those returns, you're effectively losing purchasing power. Your money doesn't grow fast enough to keep up with rising prices. Number 4. Strategies to hedge against inflation. To protect your investments from the erosive effects of inflation, consider various strategies. First, investing in stocks, particularly those of companies with strong pricing power, can help your portfolio grow in value alongside inflation. Stocks often have the potential to increase in price and profit in an inflationary environment, which can boost stock values. Another strategy is allocating a portion of your portfolio to real assets, like real estate or commodities. Real estate tends to appreciate with inflation as property values and rental income rise. Commodities like gold have historically retained their value and can serve as a store of wealth when inflation erodes the value of traditional currencies. Treasury inflation-protected securities, TIPSA type of view. Government bonds are specifically designed to adjust with inflation. They ensure that your principal and interest payments keep pace with rising prices, making them a reliable hedge. Diversification is also crucial. Spreading your investments across various asset classes can help spread risk and minimize the impact of inflation on your overall portfolio. Regularly reviewing your investments and making adjustments as needed can help you adapt to changing economic conditions and stay ahead of inflation. Moreover, when setting financial goals, it's essential to consider the impact of inflation. What seems like a comfortable retirement fund today may not cover future expenses due to rising prices. Therefore, it's crucial to plan and invest strategically to ensure your financial well-being despite the challenges posed by inflation. Number 5, the importance of investing. Understanding the impact of inflation underscores the importance of investing your money wisely. While keeping money in cash may provide a sense of security, it's unlikely to preserve or grow your wealth in the long run. By investing in assets that historically outpace inflation, you not only protect your wealth, but also have the potential to achieve financial goals such as retirement, education, or homeownership. The power of compounding, where your investment returns generate additional returns, can be a significant advantage over time. However, it's essential to balance the pursuit of returns with an appropriate level of risk that matches your financial goals and risk tolerance. A diversified portfolio that includes a mix of asset classes can provide the best opportunity to grow your wealth while managing the impact of inflation. Investing is not a short-term endeavor, but rather a long-term strategy. Understanding the interplay between inflation and investments is a crucial step towards securing your financial future. The choices you make today can significantly impact your financial well-being in an inflationary world. Number 6, the impact on equity investments. While stocks generally offer a good hedge against inflation, it's essential to recognize that not all equities are created equal in this regard. Some industries and companies are better positioned to thrive in inflationary environments. Companies with strong pricing power, the ability to raise prices without significantly impacting demand, can perform well. These businesses can pass on increased costs to consumers, maintaining or even improving their profit margins. Historically, sectors like energy, materials, and industrials have fared well during inflationary periods. Investing in these sectors or in companies that manufacture essential goods can be a strategic move to protect your investments from inflation's impact. Number 7, the role of bonds in an inflationary environment. Bonds can be a trickier investment in the face of rising inflation. When you purchase a bond, you're essentially lending money to an entity, whether it's the government or a corporation, in exchange for periodic interest payments and the return of your principal at maturity. However, if inflation outpaces the bond's yield, your purchasing power can erode. To counter this, consider TIPS Treasury inflation-protected securities, as mentioned earlier. These government bonds are designed to adjust with inflation, ensuring that your investment keeps pace with rising prices. Another approach is to opt for shorter-term bonds or bond funds. These tend to be less sensitive to interest rate fluctuations and may provide more flexibility to adapt to changing inflationary conditions. Number 8, the role of real assets. Real assets, such as real estate and commodities, can act as a hedge against inflation. Real estate, in particular, tends to appreciate over time as property values and rental income rise. Investing in real estate investment trusts, REITs, can provide exposure to this asset class without the need to purchase physical properties. Commodities like gold, silver, and oil have historically retained their value during inflationary periods. They can serve as a store of wealth when traditional currencies lose value. Keep in mind that investing in physical commodities may require specialized knowledge and storage facilities, so many investors opt for commodity-based exchange-traded funds, ETFs. Diversifying your portfolio with real assets can help mitigate the impact of inflation on your overall wealth. Number 9, the impact on retirement savings. Inflation poses a significant threat to retirement savings. Consider this. If you plan to retire in 20 years and currently spend $50,000 a year, you'll need nearly $75,000 a year to maintain the same purchasing power, assuming a 3% annual inflation rate. To ensure your retirement savings can withstand the test of time, it's crucial to invest strategically. Opt for a diversified retirement portfolio that includes a mix of stocks, bonds, and other assets that can outpace inflation. Regularly review your retirement plan and make adjustments as necessary. If you're concerned about outliving your savings, consider consulting with a financial advisor to create a comprehensive retirement strategy that factors in inflation. Number 10, the role of central banks. Central banks play a pivotal role in managing inflation. They use various tools, such as interest rate adjustments, to control inflation rates. When inflation rises, central banks may raise interest rates to curb spending and borrowing, thereby reducing inflationary pressures. The actions of central banks can have a direct impact on your investment portfolio. Rising interest rates can affect bond prices, making existing bonds less attractive and potentially causing bond values to fall. Conversely, stocks can be influenced by central bank policies, especially when interest rates change. As an investor, it's essential to stay informed about central bank decisions and their potential implications for your investments. Monitoring economic indicators and staying attuned to central bank communications can help you make informed investment decisions in an evolving inflationary landscape. In conclusion, the impact of inflation on investments is a critical consideration for investors of all levels of experience. Inflation erodes the purchasing power of your money, making it essential to invest strategically to protect and potentially grow your wealth. Understanding the interplay between inflation and investments is key to achieving your financial goals in an inflationary world. By diversifying your portfolio, considering real assets, and regularly reviewing your investments, you can navigate the challenges posed by inflation